Disney stock is currently trading at $87 a share, and today I am going to be doing an in-depth analysis. I am going to take you through their income statement, their cash flow statement, and then I am going to use my Excel spreadsheet to determine what price you should pay for Disney stock. If we look at history before COVID, and if we go back here, right here in their income statement, they hit $78 billion right before COVID happened. Then COVID happened and the revenue started to decrease massively, hitting a low of $58 billion. But as you can see, revenue rebounded nicely and it is currently at $86 billion, which is an all-time high for Disney. Here on their income statement is their net income. As you can see in this chart, their net income was also massively affected by COVID. Right now, they are currently doing $4.1 billion of net income on $86 billion on revenue. This means that they currently have a 4.7% profit margin. However, if we look back to the years prior to COVID, they were doing $10 billion on $75 billion of revenue. This means that they had a 13% profit margin. And I did the average of the last 3 years before COVID, and their average was 16% profit margin. This is going to be very important when I put my assumptions on my discounted earnings and cash flow model on the profit margin assumptions, because my opinion is that they are currently working through some issues and some profit losses from COVID, but that these margins are going to get back to normal as the parks are open again and Disney Plus is a growing and it is a very high margin business. Then, if we take a look at the cash flow statement, it's actually very similar to the net income. As you can see, right now, they are doing $1.4 billion of free cash flow. And as you can see, also massively affected by COVID. If we look back at how much they were doing before COVID, they were doing at around $10 billion of free cash flow. In order to determine what price you should pay for Disney stock, I am going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions you put in on revenue growth, profit and cash flow margin, PE and price to free cash flow, and finally the discount rate, which is the return you want to get each year on your investment. And I am going to do a 7-year analysis. Starting with revenue growth, we have seen that Disney is at an all-time high in terms of revenue. However, as the company gets larger and larger, it is going to be more difficult for them to grow. As you can see, analysts have Disney growing at an average of 6% over the next years. So I have put 4% on the low assumptions in case they struggle, 6% on the middle assumptions, and 8% on the high assumptions in case they crush it. Then, for their profit margin, I have put 16% on the high assumptions in case they get back to where they used to be, 12% on the middle assumptions, and 8% on the low assumptions. Then, their free cash flow has always been a bit lower than their earnings, so I adjusted it and went with a lower free cash flow margin. Moving on to PE and price to free cash flow, the average of the stock market is around 15. You should assign a higher PE and price to free cash flow to companies that have growth potential or moat. And Disney is the moat of all moats. It's one of the most iconic companies. This is why I went with 18, 20, and 22. Finally, the discount rate is the return you want to get each year on your investment. And because you can get around 9% investing in an ETF, if you take the risk of investing in an individual stock, your rate of return should be higher. So this is why I went with 10, 12, and 14%. Because as my assumptions get less probable, you should put a higher rate of return. As you can see, according to my high assumptions, you should buy the stock at 157, to my middle at around 100, and on my low assumptions at around $60 a share. In conclusion, I believe in Disney long term and that their margins are going to rebound. And when you value Disney, I think it's incorrect to look at the last few years of earnings. And this is why I bought the stock the other day. But this doesn't mean you should buy it. As always, do your own research. I hope you enjoyed the analysis, subscribe if you're new, and I'll see you on the next one.